Hello and welcome to a rare Tuesday night version of Darwin Investors. There's just been so much in the market that I just had to make a video tonight. I mean, last week we had the Bank of England initiate emergency bond buybacks to ensure financial stability. Earlier this week we had this Credit Suisse kind of debacle going on where people don't really know what's going on with that company as their new CEO has undergone some restructuring of that business, causing some on social media to think that maybe that bank was in trouble. And then that caused like mass stock sell off of that company. It caused bonds. People were like selling off their bonds in that company. Credit swap defaults percentages on that company went up a couple percent in just one day. And so people thought that Credit Suisse was in trouble, and a lot of that might have been engineered by our Fed actually raising rates too quickly, and also because of our dollar being really strong. However, the dollar has been weakening. The 10-year note and actually all the notes have been coming down in value. The Reserve Bank of Australia became the very first like really major central bank to pull a pivot and not raise rates as high as we thought they were going to. The PMI data came in weaker than we thought it was going to. The job openings data came in weaker than what was expected. And so for all these reasons, people believe that the Fed could pivot, and so that has been driving the markets higher these last couple of days. Plus, I'm sure there's been a fair share of short covering the last couple of days as well. But in this video, what we're going to do is we're going to talk about the reasons why investors might be speculating that the Fed will have to engineer a pivot sometime in the near future because they could be breaking the global financial systems. So let's go ahead and get into this. As I stated before, Credit Suisse is kind of a little bit of a dubious lending organization. Just because they're breaking down doesn't mean that JP Morgan's breaking down, or that Goldman Sachs or Morgan Stanley or the Bank of England or what have you is breaking down. These guys have been prone to lending scandals, apparently spies, lies, and money laundering. Some of their scandals that are a little bit more interesting ones is they have cocaine-related money laundering scandal, this Bermuda trial, which saw the prime minister of the country of Georgia awarded more than $500 million in damage from Credit Suisse's local life insurance arm. They've had this tuna bond fraud, the Archegos default. The fact they're lending money to Archegos shows that they aren't very selective in who they decide to give a bunch of money to, and they lost $5.5 billion loaning money to Archegos. And spying scandal, where the bank hired private detectives to spy on its former head of wealth management, Iqbal Khan, after he left for arch rival UBS. And so, yeah, these guys, they've had their share of problems over the years. So we don't want to just kind of automatically assume that any problem with them is a more broad problem across the entire banking sector. As a result of all their problems, you can see that their share price maxed out. It had been as high as $74 in May of 2007, and since then it's crashed 94.59%, down to a share price of $4.01. This year it's down 59.58%. Just to be clear, there's no real concrete story about this bank and why everybody is so concerned. However, they did become in the spotlight because they're having a revamp of their company, so people are suspecting something is wrong. Their bonds have reached record lows as people have sold off their bonds in mass. When you're selling their bonds, you put more on the market, cranks the yield up, the price of the bond down. However, the bank has come back and said that their capital and liquidity are strong. What makes this a very interesting story is that how much this bank has in assets under management. As of 2020, they had $1.5 trillion in assets under management. So their collapse would be a big deal the world over, even if they are kind of a dubious organization. Credit Suisse's credit default swaps hit record highs as shares tumbled. And the words credit default swaps sends chills across the market because it was credit default swaps that sank AIG during the 2008 financial crisis. So Credit Suisse's 5-year CDS is sitting at 350 basis points or 3.5%. Their 1-year CDS is sitting at 550 basis points or 5.5%. As of right now, their bonds are only paying 6.537%. So you're only getting like less than 1% return if you choose to insure these shares. So let's go ahead and talk about what a credit default swap is. This would be an example of, say, something that might have happened in, I don't know, England, where a pension fund has decided that they want to buy very, very safe bonds from from a corporation. We'll call it Corporation A. And this Corporation A says, we're going to give you back 6% back to this pension. And the pension's only going to be allowed to do this to very safe corporations. Now, the bonds are usually bought in dollars. They can be bought in any currency in the world, but often these bonds are traded in US dollars. And so the 6% that's paid back to this pension is also paid in US dollars. Now, the pension understands that although this is very, very safe, they might not be able to pay us not only the 6%, something could happen, but they might not for sure give us back our loan that we've given them. They may not give us back our original money. So to ensure that these guys get their money and they're not messing over their pension holders, they get an investment bank willing to insure this loan for them. And this is called a credit default swap. And this credit default swap, depending on the grade of the lender of the bonds to begin with, will charge a certain amount of money. In this case, this Corporation A will say that they wanted 1%. So that would mean Corporation A is not the best. Maybe they're triple B rated or maybe double B to ask for this much, because if they're triple A rated, they might only ask for, say, 0.5%. And if they buy, say, $10 billion of bonds from Corporation A, these guys will insure $10 billion of bonds. Now, the thing about these investment banks is they're triple A rated. Usually it would be somebody like a Goldman Sachs, perhaps Bank of England. And so these guys will be triple A rated. And so because of their credit rating, they're able to insure these things as many as they'd like, for instance. And so let's say they only have, say, they have $100 billion that they can insure. And they're gonna have way more, but I'm trying to use smaller numbers so as not to get people lost. But let's say they have $100 billion in cash on hand. So if they're insuring $10 billion to Corporation A, they could do this to 50 more companies. And if they all go down, these guys would be liable to buy back $500 billion and pay everybody back in insurance, $500 billion, but they only have $100 billion to begin with. They don't have $500 billion. And that's what happened to AIG. AIG was an insurance company that basically did credit default swaps and had to pay out because people were defaulting on their mortgages, and not like people that were low credit borrowers, but high credit borrowers were defaulting on their mortgages. So AIG thought that lending to them or insuring them would be safe, but as it turned out in 2008, it was not safe, and then these guys went under. Now, in a perfect world, this would work a lot like auto insurance, where you buy the bonds, they pay you the 6%, you give your 1% insurance, and nothing happens. There are no wrecks. Now, we can see where if the dollar spikes up in price and these pensioners bought these bonds in dollars and expected them to pay them back in dollars, that even if they paid a fixed 6%, if this corporation was in another country whose own currency got very devalued versus the dollar, and they were faced to pay back the same 6% in dollars, this corporation might not be able to pay this 6%, let alone give them all of their money back. And I'm afraid this is possibly what might be happening in some banks around the world. Now, in the case of Credit Suisse, they have a very dubious history. So if this pension fund wants to buy the bonds from Credit Suisse has to pay 6.537% in dollars back to this pension fund. But this pension fund, knowing it's Credit Suisse, is definitely going to have somebody insure it. But this insurer is going to say, ooh, for these guys, we want 350 basis points for the 5 year, and we want 550 basis points or 5.5% for the 1 year. Because of their restructuring going on over here, we don't know what's going on. Why are they doing this? So you're going to have to pay us an awful lot of this if we're going to insure this, because we're going to be saddled with these guys' bonds. So now that we understand what a credit default swap is and how the rising dollar can actually impact economies around the world, or certainly banks or lending institutions around the world as it goes up in value, let's take a look at how the Fed might be breaking things. And this article was made from the CNBC Pro. I actually subscribe to CNBC Pro, and just to get a hold of some of these articles. And if you get it, you actually get their television channel on your phone and everything. Like their TV channel comes with this subscription. I had no idea when I bought that, and then I turned it on, I'm like, oh my gosh, I've got CNBC like everywhere I go, and that's dangerous. I steer away from that, but I digress. So this article that came out today was called "The Fed is Breaking Things. Here's what has Wall Street on edge as risks rise around the world." The key points in this article are markets entered a perilous new phase in the past week, one in which statistically unusual moves across asset classes are becoming commonplace. Surging volatility in what are supposed to be among the safest fixed income instruments in the world could disrupt the financial system's plumbing. That could force the Fed to prop up the Treasury market. Doing so will likely force the Fed to put a halt to its quantitative tightening program ahead of schedule. Now, here's where Credit Suisse comes into play. The other worry is that the whipsawing markets will expose the weak hands among asset managers, hedge funds, and other players who may have been over-leveraged or took on unwise risks. Margin calls and forced liquidations could further roil markets. So, it doesn't even have to be an unsafe risk right now. If you are a pension fund and you went out and bought bonds on margin and you thought that was safe, you never would have pictured that these bonds were just going to tank in price. That doesn't usually happen. When those bonds tank in price and your bonds that you have, whatever you're holding on to is tanked in price, then you get a margin call. So the margin call would be, for people that are unfamiliar with that, what that means is that, when you have your account, you're allowed to borrow so much against your account. And your own money in your own account provides collateral for the loan. And some of these they're going to allow you to borrow a certain amount. However, when the value of the assets that you have, or the value of the assets that you borrowed, or the combination of both, dips below a certain point, they're going to force you to pay back at least part of what you owe them, because you're only allowed to carry so much percentage of your portfolio on debt or on margin. Now, in this case, they thought they were probably buying something very safe, something like a 10-year note, and these bond prices have completely collapsed, causing possibly a lot of margin calls amongst banks who would not normally be margin called, except for the fact that usually very safe and stable assets have started to plunge as a result of interest rate hikes. As the Federal Reserve ramps up efforts to tame inflation, sending the dollar surging and bonds and stocks into a tailspin, concern is rising that the central bank's campaign will have unintended and potentially dire consequences. The stock sell-offs get most of the headlines, but it is in the gyrations and interplay of the far bigger global markets for currencies and bonds where the trouble is brewing, according to Wall Street veterans. And they go into a little bit of history here. So after being criticized for being slow to recognize inflation, the Fed has embarked on its most aggressive series of rate hikes since the 1980s. From near zero in March, the Fed has pushed its benchmark rate to a target of at least 3%. At the same time, the plan to unwind its $8.8 trillion balance sheet in a process called quantitative tightening, or QT, allowing proceeds from securities the Fed had on its books to roll off each month instead of being reinvested, has removed the largest buyer of treasuries and mortgage securities from the marketplace. So going from 0% to 3%, being at 3% is not that big a deal. It's just the pace of the hike is just caught a lot of people off guard. It's not bad to go up there. It's not bad to calm down inflation. However, they just didn't understand the impact on the global market that going up at that speed might be causing. And at the same time, they're doing quantitative tightening where they're selling off their bonds. When they flood the market with their bonds, now there's more out there, which means the yield has to go up because it's supply and demand. You got a lot more supply and there's not a lot of demand. So the yield goes up and the price goes down in order for people to buy them. The problem was the only people buying these bonds was the actual Fed itself. So the largest buyer of the treasuries and mortgage securities from the marketplace has taken themselves out of the marketplace. And that's how they're breaking things. There's really nothing historical you can point to for what's going on in markets today, as we are seeing multiple standard deviation moves in things like the Swedish krona, in treasuries, in oil, and silver. Like every other day, these aren't healthy moves. And now, for now, it's a once-in-a-generation rise in the dollar that has captivated market observers. Global investors are flocking to higher-yielding U.S. assets thanks to the Fed actions, and the dollar has gained in strength while rival currencies wilt, pushing the ICE dollar index to the best year since 1985. So the reason why the dollar goes up when the global economy is going down is because nations are pulling money out of their own, say the Swedish krona, for instance. They're pulling money out of their own thing, and they're saying, well, we're going to invest in dollars because we're losing money in our own currency, so we're going to keep investing in those guys, right? Taking dollars out of the market, driving the price of the dollar up because they're looking at that as a safer asset than keeping it in their own currency. And that's why a rise in the dollar is usually correlated with a decline in the global economy. Such US dollar strength has historically led to some kind of financial or economic crisis. Past peaks in the dollar have coincided with the Mexican debt crisis of the early 90s, the US tech stock bubble of the late 90s, the housing mania that preceded the 2008 financial crisis, and the 2012 sovereign debt crisis. The dollar is helping to destabilize overseas economies because it increases inflationary pressures outside the US. The Fed is now in overdrive, and this is supercharging the dollar in a way which, to us at least, was hard to envisage. It is against the strong dollar backdrop that the Bank of England was forced to prop up the market for its sovereign debt on Wednesday. Investors had been dumping UK assets in force starting last week after the government unveiled plans to stimulate its economy, moves that run counter to fighting inflation. So the government of England had decided that they were going to cut taxes on the wealthiest Brits. And that didn't play well with people because they're like, look, we're trying to fight inflation and this is going to be an inflationary move. And whether it would have had a big impact on the inflation or not is up to debate, but that's the way that investors perceived it. And so they dumped their English bonds and they started moving into other assets, possibly US bonds. And so this was causing a sovereign debt crisis where pensions in England, they go out on leverage to buy what they perceive to be very, very safe assets to help out their own pensioners. And those safe assets would be the UK bonds. However, when those got dumped, the yield of those bonds went up, the price of those bonds went down, and then this debt was risking to be margin called. So that's what happened there. And that's why the Bank of England had to intervene, go buy those bonds back, driving the yield down, the price up, and keeping the pension system going as healthy as it can anyway. The UK episode, which made the Bank of England the buyer of last resort for its own debt, could be just the first intervention a central bank is forced to take in coming months. Now, right here is where the Credit Suisse thing comes into play. And then actually, I made a video a couple days ago that highlighted a little bit of this stuff too. I didn't know about the Credit Suisse thing on Saturday when I made that video, but I could kind of see a problem coming. I'll link that video like up here or something, and maybe it's there. I don't know what one of them. I'll put the video up there, and you can click on that and see what I was talking about as it relates to this paragraph here. So it says, expect a tsunami. The second worry is that whipsawing markets will expose weak hands among asset managers, hedge funds, or other players who may have over-leveraged or took unwise risks. And this would be your Credit Suisses of the world. When you have the dollar spike, expect a tsunami. Money floods one area and leaves other assets. There's a knock-on effect there. And that's what we were talking about earlier when people might be taking their money out of Swedish krona, for instance, and then putting it into US dollars. It's just, it has unintended consequences. The rising correlation among assets in recent weeks reminds Dunn of the period right before the 2008 financial crisis when currency bets imploded. The stronger dollar also has other impacts. It makes wide swaths of dollar-denominated bonds issued by non-US players harder to repay. And that's what we were talking about earlier in the example where you're having to pay back 6% in dollars, but your money is made in another denomination that's weaker versus the dollar, which could pressure emerging markets already struggling with inflation. Also, so-called zombie companies that have managed to stay afloat because of the low interest rate environment of the past 15 years will likely face a reckoning of defaults as they struggle to tap more expensive debt. And then when zombie companies start going out of business, you're going to have like a flood of people hitting the unemployment market. Let's put it that way. Like unemployment is going to spike. Unfortunately, there's only about 10 people in the world that think that unemployment is only going to go up to about 4.4%, and all 10 of those people work in the United States Fed. So they're delusional. This is going to spike far higher unless they get this under control. And by getting it under control, I'm not saying that they have to cut rates. I'm just saying they need to just pause this for a little bit so that the world can kind of catch up to these newer interest rates. Wessel also said that he believes the Fed will need to halt its QT program. You know, we can't continue sending US Treasuries out over the world. So, you know, we discussed like what credit default swaps were, and what I'm not trying to do is stoke any sort of fear, but it is kind of fun to like be at least aware of what's going on. Actually, I'm trying to quell some fear, showing that Credit Suisse might not be the best example of a company that if that bank goes under, yeah, it's going to have a horrible knock-on effect, to be sure. It's going to be nasty, but it's not that every bank is going to go down. But yeah, they do have a lot of assets under management. It certainly is a concern. It's something to keep an eye on. They're going to be giving their like statement of like what they're up to or whatever on the 27th of October. We're going to know more about this situation. So yeah, if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, you'll see you next time. Have a good day. Bye.